Welcome back to Tracking Stocks, the channel where we don't chase hype. We track what the smart money is actually doing. We follow the data, the charts, and the 13F filings, because price action always tells the truth before the headlines do. Today we're going off the beaten path with a small cap stock most retail investors ignore. Zeta Global Holdings, ticker ZETA. Smaller names like this often delivers the biggest returns. With fewer shares outstanding, there's less supply, which means institutional buying can drive price fast once it begins. Many of the market's biggest winners started as quiet small caps, being quietly accumulated before anyone noticed. When I track 13F filings, I'm not chasing hype, I'm looking for conviction. And with Zeta, that conviction is clear. Institutional ownership is up 1.5% quarter over quarter, 35% year over year, and 55% over 2 years. That's not rotation, that's accumulation. You don't track 13Fs to copy trades. You track them to see where smart money is concentrating risk. When funds keep adding through volatility, it means they see something others don't. Zeta isn't a retail favorite, but it's becoming a quiet institutional play. Now let's look at the chart. Zeta has completed what Stan Weinstein would call a stage 4 decline, a long downtrend that began in November 2024 at the all-time high of 38.20 and ended around May 2025. Since then, it's shifted into stage 1, a consolidation range between $18 and $21. Volume started rising sharply in June as the stock rallied off its lows near 11. That's a positive sign of accumulation. But this isn't a breakout yet. There's still heavy overhead supply around $26 to $28, and another wall up near 38. If Zeta clears that and holds, it's game on. Until then, patience. So why did it collapse from 38 in the first place? The market hadn't gone into distribution yet. There was no macro breakdown or sector weakness. The trigger was a short seller report that attacked the authenticity of Zeta's earnings. That report caused panic. Funds stepped aside, volume spiked, and the stock unraveled almost overnight. But Zeta didn't hide. They issued a detailed rebuttal, stood by their numbers, and defended the integrity of their reporting. Since then, the market's been deciding whether that crash was truth or just noise. Fundamentally, the story's getting stronger. Zeta just delivered 35% year-over-year revenue growth and boosted adjusted EBITDA by over 50% in the second quarter. Management authorized a $200 million share buyback and announced the $325 million acquisition of Marigold's enterprise business to expand its loyalty and international platform. Those are bold moves for a company this size. Still, short interest remains high, around 12% of the float, showing skepticism hasn't disappeared. It's a tug-of-war between conviction and doubt, and the next few quarters will decide who's right. So that's where things stand with Zeta Global, a small cap rebuilding after a massive reset. The fundamentals are improving, institutions are active, and the chart is forming a long base. But as always, let the chart confirm the story, not the other way around. If you got value from this breakdown, hit subscribe. More deep dives are coming on the names the smart money's circling next. And drop your favorite growth stock in the comments. I'm always looking for new setups to track and feature here on the channel. Until next time, this is Tracking Stocks, where we follow data, not drama.